What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered.
What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. Today, we're discussing how to direct rental income into a retirement account. So we all understand that retirement planning is important, but today we're going to kind of look at ways you can get your rental income into a retirement account if you're inclined to do so. Now, I'll start this by saying cash flow is king. Having a portfolio of cash flowing rental properties is already an excellent retirement strategy, but maybe you want to get some money and some funds directed into other retirement accounts, so IRAs, 401ks. So let's dive in and talk about how you can do that. So we have a variety of accounts out there: IRAs, 401ks, SEP IRAs. Each has its own rules, different benefits, contribution limits. So those contribution limits are going to vary by account type. Now, we've talked about retirement plans on a prior episode. So right now, I'll just kind of go into some of the highlights on your more common accounts. So we have 401k plans, probably the most well-known retirement account out there for most people, especially employees. So there's an employee deferral, the employee contribution, which in 2025, you can put away up to $23,500. If you're over age 50, there's a catch-up contribution of $7,500, bringing that total to $31,000. Now, also in 2025, there's a new special additional catch-up only for people between the ages of 60 and 63. So this is an additional $3,750 for that very narrow, limited set of people in that age 60 to 63. 401k plans also have employer contributions, so an employer match can come into play. So it could bring the total contribution up as high as $70,000 for most people, or $77,500 for those age 50 or over with that catch-up. And those in the 60 to 63 age range with the special additional catch-up, now the total can be as high as $81,250. The next most common type of retirement accounts we see are your IRAs. So you have traditional IRAs and Roth IRAs. Traditional, you contribute money pre-tax. Roth IRAs, as I'm sure most of you already know, money goes in after tax, but it grows and comes out tax-free in retirement. Those contribution limits for this year are $7,000. There's an additional $1,000 catch-up if you're age 50 or older. And then we have a SEP IRA. So this SEP IRA is a simplified employee pension plan. It's an IRA type account that it works well for self-employed individuals with no employees. So it's only employer contribution that's based on a percentage of your net income. If you're self-employed, if you have employees, the percentage is based on their W-2 earnings. And this allows contributions up to 25% of W-2 earnings for your employees. If you're a self-employed person you don't pay yourself on a W-2, you're filing a Schedule C, it's going to be 20% of your net income. That goes up. That has a maximum limit of $70,000 in 2025. That's easier to set up and maintain versus when you compare it to like a 401k plan. But because the contributions are all fixed within their only employer, sometimes it's best to move to a 401k plan when you have employees come into the picture. So choosing the right retirement account is like picking the right tool for a job. You need to understand each account, what it offers, how it aligns with your investment strategy and tax situation. So now, in order to fund a retirement account, you also need to have earned income. Earned income is income that's generally subject to Social Security and Medicare taxes. So we call those self-employment taxes. So we're talking W-2 income or self-employment income. So being self-employed would be like a single member LLC. You're not a corporation paying yourself with a W-2. But it's that W-2 or self-employment type income. They are subject to Social Security and Medicare taxes, which I'm going to refer to those as self-employment taxes going forward. Now, rental income is not earned income. So you can't take your rental profits and directly contribute those to a retirement account. So rental income is excluded from self-employment taxes in the code. However, if you're looking to fund a retirement account using your rental profits, there are ways to accomplish this. So one method is to use a management company. So if let's say you're self-managing your rental portfolio, you can set up a management company and have your rentals pay management fees to that company. Now those profits have been converted to earned income and can be used to fund a retirement account. Now, some key things to remember. Often your rentals may show a tax loss. And depending on your tax situation, those losses may be passive and suspended because let's say you don't qualify as a real estate professional. Now, if you take management fees and have your rentals pay management fees to this rental company, you may be increasing a passive loss that you're not going to be able to deduct. And then you're going to generate income in this management company. Now, if the intent is to offset that with retirement contributions, the net impact on your income taxes may be negligible. However, this management company is subject to self-employment taxes where the rental income is not. So that's 15.3% on the income generated over here. In retirement contributions, they reduce income tax, but not self-employment tax. So if you want to make sure you run the numbers and ensure you have a good reason to go this route if you're going to do it. It works, but make sure it fits into your overall investment strategy. Because maybe you have enough profit to fund something like a 401k, and the income tax savings are going to be greater than the additional self-employment tax. So it might make sense. Or maybe you're going to use this money to fund a self-directed IRA, and you expect the returns from that to more than compensate for any self-employment taxes you might generate. Which that brings us to the next strategy and the next way to leverage real estate in your retirement account, self-directing. So if your goal is to grow your retirement accounts and you prefer to stay invested in real estate, you can use a self-directed IRA. Now there's no need to set up a management company in this case and turn your rental income into self-employment income. If you're self-directing an account that already has a balance in it, now you can invest it in things you know. So self-directed IRA, really just like a traditional IRA, except you get to call the shots when it comes to what you invest in. So rather than just stocks, bonds, and mutual funds, you can invest in alternative things like real estate, private businesses, precious metals. But the catch is your custodian has to allow it. So Fidelity and Vanguard, they want you invested in their products, typically not going to let you invest in your rental properties. So these bigger institutions, they want you to buy into their funds. Plus, there's some strict rules you need to adhere to, and they don't want things to go wrong and run into a situation where your account gets disqualified because you didn't follow the rules. So typically for a self-directed IRA, you're going to use a specialized custodian. So here's where it gets a little technical, so just stick with me because it is important. There are prohibited investments and prohibited transactions. So the prohibited investments, so the IRA or the IRS doesn't allow you to invest in things like collectibles or life insurance, S corporation stock. So there's a very short list of prohibited investment types. However, where most people get tripped up are things like self-dealing or using the IRA account for personal benefit. So let's talk about what that means. So there's a term called disqualified persons. That includes you, the IRA owner, your spouse, kids, grandkids, parents, grandparents, any business that is owned by you or any of these family members that's owned 50% or more is also a disqualified person. So what happens here? So a prohibited transaction happens when your IRA interacts or deals with any of the disqualified people. That could be lending money, renting out the property to a family member, or you even doing work on the property, like sweat equity, can get you in trouble here. So you can't use the property personally. You can't guarantee a loan for your IRA. You can't fix up the property yourself. If the IRA engages in a prohibited transaction, then the account's distributed and taxed in full, plus a 10% penalty if you're under age 59 and a half. Now, a few other things to be aware of are there's a couple tax implications. So IRAs can be subject to tax. You have UBIT, which is unrelated business income tax. That kicks in when your IRA earns ordinary income. So if it's operating a traditional business or flipping houses. The good news is rental income, interest, dividends, capital gains, they're all exempt from UBIT. So you're not going to run into an issue with say, your rental income. However, if you're using leverage like a mortgage on the rental property, there's another tax called UDFI, unrelated debt finance income, that comes into play. So a portion of your income may be taxed if you have a mortgage on the property owned by your IRA. Now, 401k plans are exempt from UDFI when they use leverage to buy real estate. So that's something to consider. If you're comparing an IRA versus a solo 401k and you're going to self-direct, the solo 401k avoids this UDFI. And then these taxes get filed on a Form 990T because the IRS loves their tax forms. And when done right, there's self-directed IRAs. They're a fantastic way to supercharge your retirement strategy, especially for real estate investors, because now you can tap into those retirement resources and use them to help build up your real estate portfolio. So let's recap. Using rental income to fund your retirement account, definitely a viable strategy if you execute it correctly. So you can convert some of that passive income into earned income by using a management company and then select the appropriate retirement account. We have self-directed IRAs, let you invest in things that you know, like real estate. Just be sure to avoid those prohibited transactions and prohibited investments and know who disqualified persons are. But again, still probably the number one best thing for your retirement. Does it involve a retirement account at all? And that's just having a portfolio of properties that cash flow. That about does it for today. If you found value in this episode, please leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax-related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.